why we feel that there are a lot of jargons used by.
May I request others to please mute yourself, except Vivek?
Thanks.
Yeah.
So a lot of jargons do come up and then try to disturb us, but actually, if you get into it, it again the basics of total business and returns, how it is, and protecting of each other's interest. So that is what it is. So see, one important is why is the fundraising important as such? That is the whole thing about it. Because one, funds are, we know that today the way the startups work is that their growth is accelerated growth. They're not in arithmetical progression, but in a geometric progressions. And when they want to go a geometric progression, funds are very much required to go and capture the market. So there's an accelerated growth that is there. And apart from that, these funding, as professors did talk about, a lot of things come to the smart money. When a VC invests, he gets a lot of guidance on the industry that is there. Those are the other benefits that is there. So that is how these funding happens. And these fundings are pretty risky funding because we are all investing in the future. Startups are all about the future, nothing not about a proven track record, but it's going to talk about what likely to happen in the future, what likely habits are going to be created, and do that. None of us could have thought about the food deliveries ecosystem that could have been created as such. When it started, it was just a thought process, but later on today, what we are seeing is the reality of it. And to do that, to change that habits, there were a lot of funds required for it, and there was a lot of burn required. So if you go to a funding cycle by a startup, what happens from that? Very simply, I'm going to do that. After startup is started, they create an investor pitching. Pitch deck is created. That is go ahead and then given to investors, depending upon the stage of the startup is, they go to the right kind of a financial institution or angel, etc. And they feel that the pitches, if the investors are in line with what you have been pitching for, then you start with the term sheet. That is what we're going to discuss most of it as the term sheet one, which is basically a framework for negotiations that is there and for a finalization of the investment thing. Once the term sheet is signed, then they do a due diligence on the startup. Basically, it may be tax, finance. Most important is the business due diligence that is there to see whether whatever the projections that have been given, the market strategy that they're talking about, is it that's fine. And once the due diligence is cleared and then it's in line with what the thought process was, then they get into the definitive agreements called the shareholders agreement and share subscription agreement. After that, they have to complete certain condition precedents as such, that is before the money hits in, what are the condition precedents has to be done. We'll talk about it. Then post investment, there are certain condition subsequents that are there. After that, there's a continuous monitoring, the growth of the fund, everything. And then finally, there's an exit that is there for the investment that has been made. So more today, we are going to talk about the various terms of the term sheet that is there, which is basically nothing but a framework that is created for it. And uh, at this stage, it's a very, very important thing because it is possible to negotiate on terms here. Once the term sheet is done, signed off, then when you go to definitive agreements, then it's not more of a bargaining or negotiation, but more of detailing for it to see that the shareholders agreement, definitive agreements are in line with the term sheet. So it's very important that term sheets are very much clearly worded, and then all the negotiation happens here. Um, the way I expect is, if, because as I'm presenting virtually, I would not be able to see any one of you. I can just see the screen of it. So if there's any person, any query at any point of time, please, even if you raise your hand, I may not be able to know it. That's how my screen is there. So you just voice out and then ask for a question, and then I should be able to answer that. And let's make it as interactive as possible for that. So what forms part of a term sheet? There are various clauses in a term sheet which can be categorized under these broad headings. One is the investment details, which is talking about the amount of investment that is going to happen, at what valuation it is going to be there, and what is the type of instrument that are going to be there. And most other than that is the cap tables that comes as an annexure. As to cap table is basically the shareholding pattern of the entity which is taking the investment, which we call it as a target company in normal terms. So you give the current cap table, that is before investment, what is the shareholding, and then after investment, what is the proposed cap table, how does it look like as such. And then also what happens is most of the times these investors tell that carve out some amount for ESOPs. Now ESOPs, as we all know, that it is only a carve out or the reservation of the capital for the future. And then these cap tables normally have on a as it is basis and on a fully diluted basis. Why do we have a fully diluted basis is basically is that most of the times these investment by the investors come as convertible shares, not as equity shares. So if it is converted, as if it's converted, what would be the number of equity they have and what is the cap table at that point of time? That is what is normally looked at on the proposed one. And in this case, they also assume that all the ESOPs are exercised and issued. And if after that, what would be the shareholding pattern is what it is. So on a fully diluted cap table would never be in line with the actual cap table, which is used for the statutory purpose for your ROC filings or all other things be there. But investments always works upon a fully diluted basis. That would be on the cap table. Um, then we have basically we know that when these investors comes in, we all know that they come in under preference shares. Why do they come as preference shares rather than equity shares? Is because they would want to enjoy certain rights and preferences over the other common shareholders. And we'll look into these terms in detail. One of it is called a liquidation preference, which I'm going to talk in detail about it. Second, it talks about dividends, and dividends would be even a priority over the common shareholders, and their voting rights. And these voting rights may not be just a 1:1. It can be a different type of voting right. For example, have a voting right which says that on certain matters of importance, when there's a new acquisition that has to be done, when there is a change in the name, when there's a change of sale of an undertaking that is there, there's a mandate veto right by the investor. Unless until the investor approves it, you cannot do that. Though they might be having in terms of shareholding, they might have 15%, 20%, 30%. And you know that many times a regular resolution can go with the 51% or the promoter holds in. But by an agreement with this, the voting rights are such that given that they have a better right than what they have and they have a veto rights on that. They also talk about how many board seats they need to get. So like this, a lot of rights and preferences are given, and this is all part of the term sheet. You have to negotiate with it and do that. Well, looking at a term sheet, we may look at it from both the sides. One, as if you might be an investor in some cases, or you might be the startup or advising a startup for that. So depending upon which hat we wear, we need to see our own how our rights are protected. However, at the same time, what is important as professional is it's not that we only our rights are protected. We also need to see the other party's rights are protected because today when an investment happens, it's a marriage between the investors and the promoters. And even if one of them is not happy in that marriage, then the marriage can fail and the business can fail. So it's very important that the interest of both the parties are considered and it should never be a one-sided agreement as such. So as a professionals, when we are, whichever way we are looking at it, we need to take care of the interest of both the others. As long as it is made a win-win to both of them, that is when in the long term, things are going to be better off on it. One of the important preference right that is there is a anti-dilution clause. I will talk about it in detail on that. So let's park it there. Then what happens is that there is something called a founder vesting, which sometimes I have not seen many clauses, term sheets in India having a founder vesting, but that replaced by a lock-in clause. What actually is meant by founder vesting is all of us have been aware of ESOPs. When we get 1,000 ESOPs, it says that they might have a simple policy of over a period of 4 years, 25% vest each year, and then you exercise, and then you become the shareholder of that. Like that, they also have a founder vesting, though the shareholders have a shares, their rights on those shares, we make it through a conversion as such. They've also been given, rather than equity shares, they're also given preference shares with a convertible, which gets converted, 25% of that gets converted to equity as long as they continue with it. Or sometimes they link it to milestone based, that you need to achieve X turnover, X market share, X number of customers you should have acquired, etc. That would be talking about, and then that goes for a vesting schedule as such. But sometimes when it is close to any transaction that's happening, suppose there's a merger acquisition happening or a takeover happening, there's a clause always for an accelerated vesting, because the 3 years, 4 years would not have happened, but an transaction is happening, and because the promoter should not be left without shares, the clause should also talk about an accelerated vesting. But in most of the term sheets that what I've worked upon, the promoters themselves will not have a vesting schedule. However, they have something called a lock-in period. That means the shares which is allotted to them, they cannot dispose it off before a period of 3 years, 4 years. Because why is it so is, when the investor is investing, he's investing in a startup based on the capability and the leadership quality of the promoter. If they're investing based on the promoter's vision and dreams for it, that is what it is. If the promoter himself divests and goes away, then the investor is left in a lurch. Therefore, they put in a lock-in period that he cannot sell before 3 years, 4 years. That's how they put in that. And there's a lock-in term that comes in. There are also other terms that are there in a term sheet. One of it is called the conditions precedent. That is, before even you get into anything, even a shareholders agreement, what are the conditions precedent? Maybe they say that due diligence to be done. Sometimes the company itself is not incorporated as such. They just do it on Excel sheet, the whole thing is done and the term sheet is signed off. They say, oh, the company should be incorporated, legal entity should be there. So those are the conditions precedent that comes on it. And there's an exclusivity clause. Once you sign a term sheet, they say that you can't go out in the market and then keep looking out for further funding, who is giving a better deal. Because in market, always you can get a better deal also. So they say a 90-day period or a 180-day period, there's an exclusivity once you have signed a term sheet, that you can't go to the market and then look out for funding. Then there is a clause on due diligence as to who is to do the due diligence. How is the cost of due diligence to be met? Whether it has to be met by the target company or it is 50-50 or only the investor is looking at it. It's all the negotiation terms that are talked about. Then this term sheet also has things called the exit terms for the why is the investor coming in? He wants, we all have heard about it. These VC funds are again a time bound periodic fund. They need to return back the money. The GPs need to return back the money to their LPs. So they have an exit term. Within 5 years, you need to go for an IPO, or 7 years. Or they say that if you, after 5 years plus 2 years, you don't go for an IPO, the company needs to buy back at a pre-agreed value, etc. That's also what these exit terms are talks about. I hope the speed in which I'm going, is that okay? Is it too fast or less? If somebody can.
It is okay. It is okay.
Yeah, it is okay. I have one doubt. Can I ask?
Yes, yes, please.
So it's binding and non-binding clauses. Is there any SEBI regulation is there for the ventures to, there must be exit clause of 7 years or something like that?
Okay. Let me tell you, when you sign these term sheets in a startup, these are all unlisted startups. And all this doesn't come part of public fundraise. It's all private fundraise. So SEBI is not involved in this at all. These term sheets. So,
I'm not able to listen. Is there any problem in the connection?
There is a disturbance.
I muted it. I muted it.
So there is somebody double on is there. Somebody can go on mute.
I think you can go on doing it.
Yep. You can start, Vivek, now, please.
Okay. Okay. So here now I go into few important aspects of the term sheet that what we saw. The instrument type itself would be the common equity or preferred. Now, one may try to understand why will go for a preferred than an equity share. The reason they go for preferred is so that, as we saw earlier, there are a lot of rights that is associated for the investor. So these rights are normally not available for equity shareholders. Therefore, they go for a preferred. It's not just that the preferred shares are having a liquidation preference over the others as such, but the right, like the voting rights are preferred. There is anti-dilution rights that are there. They have a return on first capital even when a sale happens, how much they should get first as such. And these conversion rights are available for them. They have a veto right on to say in that. So they have a lot of preferred right. Therefore, people go for a preferred instrument as such. Now, what happens in a preferred instrument is between the investor and the target startup, a lot of commercial transactions are done and they negotiate and then agree upon it. But however, when you actually want to implement it in Indian terms, it's many times it's pretty difficult. I will explain that in due course, what we face difficulty in practical implementation and how it needs to be handled as such. So that is the equity shares that are there. Then you also have something called a convertible notes. Basically, what are these convertible notes today, which is much more, lot of vogue is that they give it as a loan today. It's not as equity, it's given as a loan. But however, they say when it is a loan period, it fetches a rate of interest, say 10, 12, 15, whatever the negotiated rate of return is there on that. And then they say either in a future event happening, when a next round of, suppose Series A is given as convertible notes, Series B happens, these convertible notes would be converted to preference shares. That is the conversion terms, they say that. Or when they go for, once the revenue reaches, say, 5 million, we will convert the note into a preference shares. Because as long as it's a note, it's a debt, and the company first has to give it off to the debts and then to the shareholders. Therefore, they would prefer it as a convertible note. And this convertible note also would talk about, because the money has been given today and the conversion is going to happen, say 24 months from now. So how do you do that? Say, suppose what they normally do is, say you are given $1 million is the convertible note that is there. And they say that you convert this $1 million at a valuation that is agreed by the next round of Series B investor. Suppose Series B investor says $5 million is the value of the company. Till at the time of convertible note, no valuation is done. But next round does the valuation for $5 million. Then normally conversion would be 1 million, 5 million plus 1, and you get 1/6 shares is what you get. But however, since you have already pre-invested it 24 months before, you also agree upon a discount factor. So there is, some people agree about 1 to 1.5% per month. So say suppose it is 1.5% per month, then it is 18 plus 18, 36% discount. So what you do is, first 5 million value, you discount it by 36% and then add 1 million. So pre-money would be 5 million at a discount of 36%. Okay, that would, let's go 1 second. So it's around 3.2 million plus 1 million. So it is 1 by 4.2 million. That would be the equity stake that you get based on the discount as such. So therefore, you get a better return on that. And also it is very much a vogue where it's in a very, very early stage of a startup, because early stage of startup, you need funds for a prototype just to make the proof of concept work. At that point of time, you just go on the gut feeling that it's going to be working, but you don't want to value the company. So therefore, they go by a convertible note. Similarly, convertible note is called the simplified agreement for future equity called the safe agreements. Today, quite a lot, if you go into startups, you get safe agreements. What's the difference between safe agreement and this is? The safe agreement, it is not a loan. It is amount given already, and there's no return back of the amount possibility. It's only that only the conversion terms are given at the same type or like a discount that is there, like 1.5% or 1% per month. That is given. The valuation is not fixed today, and you get a conversion, and then you don't get an interest rate. So difference between convertible note and safe is convertible note is a loan. It has to be repaid back if required. If doesn't happen, nothing happens. It has to be returned back. But in safe, you don't return back. It is an equity with a future conversion terms only at the future that is there. So these are the different type of instruments that are used for investment as such. Any questions on this?
Yeah, Vivek, I have a question. Just from an investor's point of view and from the business owner's point of view, what are the best, like, what would one go for? I mean, would I go for a preferred equity all the time, or I mean, what do you think from your experience, the best
See,
or most used options?
from an investor point of view, preferred is always better because I need rights for it. From a if a person who's taking it, for him equity is good, but the investors always have the call for it. But when you look at convertible notes or safe, then let me tell you how it is there. Because if I try to go and I have an idea in my mind, as a startup, I want to go and convince the investor that this is the market potential, this is the investment. At the very early stage, it's very difficult to convince on valuations as such. So
Yeah.
therefore, but I need the money for it. I cannot leave quiet. I need the money for it. So therefore, what I would go is I would go for a convertible note or safe because I don't talk about valuation. I use that money to build my business, and then in Series A or Series B, it's normally convertible notes are taken even before Series A. When a Series A investment happens, a valuation is done, and I'm ready to give them a discount. So that's safer for me also of looking at it and all that. At the same time, what also when we do in a convertible note is that we have a floor conversion. Basically, we say that there's a minimum conversion term. So we say that, hey, today you give me 1 million, but conversion would be at a discounted rate of the future. But whatever may be, it will not convert less than 5 million pre-money valuation. That's something what we also put into as such. At the same time, from an investor side, he will say that I also, if you are asking for a floor, also give me a cap. That because I'm already there, I'm not going to convert it on a value not more than $15 million pre-money
Mhm.
valuation. So there's a floor and a cap that is there. The startup asks for a floor and the investor asks for a cap on it. So many times this is also what we have seen on it.
Okay. Thank you.
Vivek, one sec. Vivek, just to add, you will see convertible note in the current market scenario also, wherein the investor not getting the expected valuation. So they are thinking the market would turn maybe in a year's time or 2 years time. So
Mhm.
till then they are taking the convertible route.
Correct. That's,
Right?
that's also
Like
right.
if you look at the article, there was an article in ET today only wherein it mentioned about Udan taking a convertible route or debt route. Even Baiju's 1.2 is, I think, convertible. It's kind of a debt.
Yeah, it's
It's
kind of a
linked
debt.
to the it's
Yeah.
it's a debt. It's, so I don't think it's a convertible. But there have been other instances also like Infratech took again a convertible route.
Yeah, it's correct. As you rightly said, that when things are
Correct.
little hazy, the
Yeah.
investor feels, why take the risk of equity? Let me
Correct.
give it more of a loan. And these loans are normally, they also do it as security. In the real world, they do quite a lot. For example, if Byju's is taking something, they would have secured it against the equity shares of the promoters. They would have done that. They would have done an agreement for that.
Correct.
So all that
Baiju's actually was a LBO model. Baidu actually was trying to do LBO. They had taken that loan to acquire a company,
acquire a company. Yes.
which that transaction didn't go through, and they used that money in India business.
Yeah, correct. Okay.
And safe typically you will see only in early stage startups.
Very early stage startups.
Safe
Today, there
actually,
are,
if you look at the name comes from there's a company outside which was promoting kind of crowdfunding.
Okay.
And then from the other name, they prepare that standard agreement which can be signed by the investors and the investors for the company, and then it started calling safe agreement.
I know.
That's what I know.
I know. 5 to 7 years back, we used to do this agreement, but we never knew it was called safe.
Yeah, much more prevalent outside India.
Yes.
Much more prevalent outside India. Typically early stage startup, when the angel investors investing, not even angels, before that, when you're investing, it will be a safe agreement typically.
Today, there are a lot of retail investment that happens on an app.
Correct. It's for retail only. Safe. No, none of the VCs do the safe.
Yes, because it's a very simplified agreement.
Correct. You won't have the rights
for future equity. Very, very minimal rights. Just conversion terms are there. No liquidation preference. Not so many things are just not there. It's a very, very simple agreement. It's a retail angel investment. Agree with you.
Correct. It is basically okay. On the next round, we'll get the conversion at a discounted price. That's what it simply says.
That's right.
Vivek ji, I think there are people with raising hands, so I think you should take that.
I see. Unfortunately, I'm not able to make.
So Chaitanya has raised his hand, and then it was Tanvi, but Tanvi has.
Anybody can tell me how do I also look at?
It would be there on your right side of the screen. Whenever
Can you see show everyone maybe at the bottom where you can see all the participants? I don't know whether you can see that while you're presenting.
When I'm presenting,
so we will have to.
How do I look at my presentation?
Chaitanya should go ahead with this question.
Yeah, Gmeet, I think that's the issue.
Vivek, you cannot see the space when you're presenting, so someone else has to moderate along with you.
Yeah, Arun, can you do that? I have my colleague Arun, so that if we can, Arun, if you can do that, that would help me.
Sure. As of now, Chaitanya and Tanvi have raised.
Chaitanya, Tanvi.
Yeah, Vivek ji. So on the convertible note, I just wanted to know if there's complete clarity of taxation, because the way you said, say 1.5% accrues, and some at the end of say 1 or 2 years, the shares get converted. I mean the notes get converted. How does the taxation work on that? Because does it get counted as interest, the discount, or does it get counted as a issue? Yeah.
That's a good question. So what it does is it gets you a right of 1.5% discount for your conversion. That's all. So you already have an agreement. That means you have an option. It's like an option, an option which is giving you this right to convert at so and so rate, and that's your choice. So from a taxation point, it just reduces your cost. See, your investment is the same, right? If you have put in $1 million, $1 million is there.
Right.
But you get the shares at a high discounted price. So it's a discount. It is there and not an interest on it. But however, see, if you are giving interest, what happens is many times there are two ways they're giving. One, they give you an interest, say 6% interest, and then they give, that is an income. And then apart from a 6% interest, they also give you so that is 6% interest would be 0.5. Apart from that, they give you 1% discount. So together it's 1.5. 6% is given as interest, another 1% as a discount. The interest is taxed as income.
Okay.
And 2% discount is just you get that at whatever rate that is there. And interesting thing for it is, if it's a convertible note, please look at it. You get your shares only after 2 years. So it is from the date after the 2 years, that is when actually your shares comes into play. And from there, you need to hold it for your long-term purpose for 2 years after that, not from the date of the convertible note as such.
Okay. And SAFE gets classified in the balance sheet as debt or equity, or in the balance sheet of the startup?
It would be coming as an equity itself as such. But of course, if you look into purely Schedule 3 and those, if you look at it, that is where the challenge would come under as to what this is. So basically what we've been doing, that whenever it is safe, as it's a simple agreement, but what is done is you give a preference shares, which is a conversion term which has got this discount and treat it as preference shares.
Okay.
Convertible notes are treated as liability.
Right. Okay. Okay. Yeah.
Uh,
Thank you. Thank you.
yeah. Yeah,
So,
Vivek, I have a question.
Yes.
Now you're talking about conversion being a debt. I don't think so, because when you say it's a convertible debenture, it is an equity. It's stated as an equity only in books of even banks or debt trading institutions. They take it as only equity or a quasi equity. They never take it as debt unless and until you call it as an optional convertible bonds.
Yeah.
If you say optionally convertible, the put or call option is rests with the investor or the promoter.
Okay. See, if you get deeper into it, there is the CCD, compulsory convertible debentures. Those are treated as actually as equity. But convertible notes are a loan. Today, the regulations allow for a startup to take a convertible loan. It is basically a convertible loan, which is a debt as such.
No, it's an optional. Is it an optional convertible note or a convertible note? See, the definition is very important here.
It's an optional convertible note. So its option is there. It's not a compulsory convertible. So it's an optionally convertible. So it depends upon the terms. If it is compulsorily convertible, then you take it more towards the equity. But if it's an option that's there, either you seek a repayment or you seek a conversion. It again depends upon the terms of your note as such.
Okay.
And you're right. If it is compulsory convertible, then more goes towards the equity. Then the bank also looks at it as an equity. But if it is an optional, then it is a loan. For example, safe is definitely not a loan.
Correct.
Definitely it gets converted only. There is no meaning of turning back as such.
Absolutely. Absolutely.
Vivek, can you
Yes.
please help us with an example of something like that? If there is a CCD round is going on of around 5 crore, right? And there is a flow rate attached to it, pre and post valuation attached to it. So how much, how we will, evaluate in such a term sheet that how the flow rate is calculated, the significance of the same. That's what I really want to understand, the whole through example or something like that.
Okay. So let us say that, let me take this example of $1 million is the CCD. And we have a discount rate in the future. But a floor rate says that minimum conversion would be at $5 million valuation. Okay. So that means irrespective of whatever discount that you apply, what it is, you get 1/6 of the your stake would be only 1/6. That is, you get 16.6% is what you can get, even if the discount is very high, what it is, that is there. That is the floor. And the cap would be, let us take, say, pre-money valuation after discount or whatever it is, it not be more than $15 million. So you get 1/16 is what you're gonna get the shares. So that is how the cap is. Now you have to look at it. How do you come with this floor and the cap? So how do you go valuation? You will go by the normal, pessimistic, optimistic valuations that you look at it, and you give different scenarios for that. And based on that, you say, hey, this is the base minimum. I know that the business cannot go below this, below $5 million. It just cannot go. And this is my valuation even as of today. As of today, whatever horizon I can see, it's $5 million. So that is where the floor comes in.
Okay.
Okay.
So it's something like down the line, if the valuation doesn't go to that beyond level, so
Yes.
we will give you the shares to that particular rate.
Correct.
If it's go beyond the level, then obviously the rate would be something like that.
So for example, let us say actually it's $5 million floor is there. The actual valuation next round is only 3 million.
So it's just a sort of a down round for them, right?
It's but you still get it that because you have participated, you get 1/6 only, because for you the conversion would be at 5 million.
Right.
Suppose the valuation goes to 30 million. Because I'm an early investor, I would say that don't want to participate at 30 million. I've come here, supported you. So I'm not going to come in at anything more than 15 million.
Got it.
Okay. Now we have a lot of preference share types. We have already discussed about this cumulative, non-cumulative, everything. Only one which we have not discussed in the class is something called optionally convertible redeemable. See, anything can be done in this finance sector. Structurings are done there. So here the option is with the investor. Normally it's with the investor. Sometimes with the target company also. We have done both, and this either after that, then there's a redeemable preference share. We worked upon a real estate transaction where we had given this OCRPS. The investor said that I want the right to convert it, but till that time, I want it as a redeemable preference shares. And he went with a very, very strange thing. He said that he went on a IRR basis. He said, first, when this was for a residential project that was happening, till 30% of the apartments are sold, I would go on an IRR of 18% IRR. I want my return. After that, from the 31% to 60%, they said that they would want whatever returns are coming, both there's a share between, even the promoter had come in as a OCRPS. They said out of that, 60% to the promoter, 40% to the investor. And then after that, in their ratio. That is how they had done this agreements as such. So lot of structuring is possible when you want to do this. But please remember, all these redeemable preference shares or optionally convertible is all possible only when you have resident investors. When you have non-resident investors, FEMA comes into play, and FEMA wants to make it only compulsorily convertible instruments only, either compulsory convertible debenture or compulsory convertible preference shares only. Other than that, these things are not possible under FEMA. So next is one of the important.
Could you just repeat the last sentence?
So under
Actually, that is very important for us, because of lots of investments are coming from outside, and we are also dealing with investors. This detail is also very important. Please explain it more.
So under FEMA, the law says it has to be compulsory convertible debentures or compulsory convertible preference shares only. It is compulsory. There's no question about return back. That is when it comes under the FDI formula, foreign direct investment regulations, is equity only. So it should be either, today you can give a preference share, but it has to be converted compulsorily to equity. And debentures also compulsory convertible. There's no option. There's no redeemable thing. If you're making it redeemable or optional, then it comes under the ECB guidelines. The under FEMA, you need to go for the ECB guidelines, because FEMA would treat that as a loan, because even a potential repayment would mean the money is going to go outside the country, and therefore it has to go for ECB guidelines and not the FDI guidelines. Hope we are aware of it. FDI guidelines for equity, and for borrowing it is the ECB guidelines. Is that clear?
Thank you.
Okay.
Good.
So next comes, what are different preferential rights are there, right? So I'm not going to spend more on this. When I come to that particular slide, I'm going to do that. This is a very interesting one. One is the most important terms in an agreement is the anti-dilution clauses. This is a very important negotiation point between the investor and the target company. As we heard by the professor talking about it, suppose you have invested, an investor A has invested at, say, 10 rupees per share. Face value, let us say 1 rupee. You invested at 10 rupee per share in good confidence that it's going to keep going up. After whatever it is, there's a downturn in the business sentiment. It happened during the COVID time. There was a downturn in the business, and the valuation dropped down, but you still need money. So you go and raise the next round of shares at 5 rupees. Then the earlier investors valuation gets affected, because he went with a 10 rupee one, and then now somebody is coming at a 5 rupee one. He gets diluted full. So therefore, there's something called an anti-dilution clauses. Let me just explain to you on 1 second. On this anti-dilution clauses, I have done some Excel. Let me just see if I can share that. Is this pretty visible as such?
You can maybe zoom in a bit.
Zoom in a little bit.
Um, just yeah, that's better.
Okay, so in a go for anti-dilution method, the way they work is there's a full ratchet anti-dilution clause. That is basically, this is the worst case of anti-dilution. That's especially for the anti-dilution is very bad from a promoter viewpoint. If you go for an anti-dilution clause, you give it to the investor, promoter loses out a lot. Let me show you how it happens. So as I told you, investor A, when he invested 10 lakh rupees at 10, he got 1 lakh shares issued to him. Investor B, after 1 year or 2 years, he comes in at 5 rupees. Now what happens, because he got at 5 rupees, for the additional, now if the average value of per share should be there for 10 lakh rupees, for investor A, we need to allot him another 1 lakh shares. If you allot another 1 lakh shares, this also becomes a 5 rupee one. So now let us look at the cap table, how it would be like. So suppose this is a 1 rupee share. The founder had invested 6 lakhs, he got 6 lakh shares. Investor A 10 lakhs and he got 1 lakh shares. So currently before the pre-down it is 86% and 14%. Post down round, what happens is for the investor, sorry, here it should be. For the investor, for the same 10 lakh rupees, if you look at it, 6 lakhs remain 6 lakh for the founder. For investor, it becomes 2 lakh shares, and for the new investor, he gets 1 lakh shares. So now, if you look at it, this person's holding from 14%, it became 22%. He actually, there was a new shareholder coming in. That the new shareholder coming in, normally I should have diluted. But because it has gone at a down round, this person's shareholding has become 22%. And the promoter shareholding has dropped from 86% to 67% with the same shareholding that is there. And if you, if it had happened, if there was no anti-dilution clause, if it was a normal this thing, you look at it, what it would have been. This person's, the investor A share would have been 13%, promoter share would have been 75%. So if you have an anti-dilution clause, it is very not friendly with the investor. And the full ratchet one doing this is definitely not friendly with the investor at all. And also it's very important, why is the promoter raising money at a down round? Because business is not doing well. He needs money. Now, by taking money, if the investor has to dilute a lot, for example, we saw one share which is done at 5 rupees per share. In that case, if anti-dilution is done, the investor's holding will come down to 5%, 10%. The investor shareholding comes to 5%, 10%. He doesn't have interest to grow this business to the next level. Then everybody who was invested in it will also fail. Therefore, we should never, even from an investor's point of view, though it is favorable, they should not go for a full ratchet clause. Next, what they have is the weighted average anti-dilution clause, which gives weightage to the price at each round and do that. There, they have two type of weighted average. One is called a broad-based weighted average, and then there's a narrow-based. Now, in a broad-based weighted average, what it considers is when it takes this weighted average, it considers all the shares, the founder shares and investor shares, ESOP shares, and some shares would have been issued for a merger acquisition or for some advisors price. So consider all that and then they do that. Let us give an example for that.
In this, Bhupendra has a query.
Yeah. Yes, Bhupendra.
In that first example, in that anti-dilution clause, investor A's shareholding has been increased from 1 lakh to 2 lakhs, right?
Correct.
So just means practically how that shares will be issued without consideration.
Yeah, this is a very good question that is there. So in concept, it is there. But what happens is, this is where again the issues come up. They still need to take a nominal amount as per law. What is as per law? If it's a 1 rupee shareholding, you have to take at least 1 rupee you have to take. You can't give it a discount, right? So you collect for 1 lakh shares, you collect 1 lakh rupees. That would be there in the terms. However, again, please note, if it's under FEMA, if it's a foreign investor, it is not possible at all. Because under foreign investor, if you have to allot shares to a foreign investor, it has to come above the fair value that is done. Current fair value, if it is 5 rupees, even from investor A, without collecting 5 rupees, it is not possible. So how do they manage this? This is a very interesting question that you asked. Thanks for that. Normally what they do is, these are all preference shares, convertible preference shares. So they manage the conversion terms to that. But however, FEMA goes further, says that even when there's a conversion instrument, at the time of conversion, it should be above the fair market value of what that has been done today, today's time. So now what we used to do in practice is, though I used to allot at 10 rupees per preference share with the conversion norms, with the anti-dilution there, I used to estimate in future, worst case scenario, maybe 20% would be the downfall that will happen. So my valuation would have been at, I see that my valuation, what I obtained is at $8, 8 rupees per share, but actually at the fair value and actually allot at 10 rupees. That way, I know that even in the future, when a conversion, this anti-dilution happens, when the conversion happens, it is above 8 rupees is what it would be there. However, this causes income tax issues for it. Because if your fair value is 8 and then you allot it at 10, you know that we have section 56 called the angel tax. This $2 comes for taxation. So you need to be very careful when you are doing that. It's okay for you to go with that and then do that. So that is how it's happening. But the law says that you cannot do, you have anti-dilution clauses and all. Do that. It is one of the main reasons, if you look at it, lot of companies have their startups in India, have their parent company in Singapore and other countries or US, because they feel to give rights to all the terms of a shareholders agreement, what they've entered into commercially, it is very challenging to do it in India with the regulations that is being there. But if they do the fundraise, say in Singapore, then they don't have these matters. So we have seen Flipkart, we have seen Capillary, these companies have all done it outside India and they raise that. Otherwise, in India, definitely it's a challenge. Conceptually, we can talk about this as anti-dilution clause and all that, but anti-dilution clauses, to implement it, it becomes a pretty big challenge. One of the things is the conversion route, you still use it, but still it's a challenge when it comes to a foreign investor. This works well for an Indian investor, it works well. I hope I gave some clarity on that, but it's a practical challenge.
And so typically you will have domestic as well as the foreign investor in the same round. So then it becomes more challenging.
Yes, yes.
Because most of the cases you will have that scenario that you will have a domestic as well as a foreign investor in the same round. So you can't go up or down even by a rupee.
Correct, correct. That's also that is, you have to have the same value for both.
Correct.
That is also there. But these are protections they build in from a legal point they build in, which with the thing, but okay, because the law doesn't provide, so let me not have anti-dilution clause at all. No, they would not want to do that because they're also hoping that someday the law itself might change. The best thing would be that there was this case between, I don't know, there's a telecom company, I'm not able to recall that name, where they had given a minimum return for the exit. But the court said that minimum exit was not possible at all because FEMA did not provide for it. But they went for an arbitration and then finally they said contractually you are required to do good for it. FEMA doesn't allow for it, but contractually you need to do good for it because you have agreed it. You figure out a way how you can compensate him for that. So that is how it went on to that. So
Vivek, tell me something. Will you have anti-dilution kick in case of rights issue?
Okay. So basically, you need to, when you're doing the definitive agreement, you need to say that in a rights issue, I will not have anti-dilution. Where I am on, so that's one because rights issue is being performed by everybody. That the investor also
like Farm Easy. Farm Easy. Everybody in media has been talking about the anti-dilution getting kicked in.
Yes.
But there has to be a reason they have done a rights issue, not the preferential allotment.
Correct. So
It might just be, we don't have the information, but it might not be a dilution.
Correct. If the pharmacy agreement says for rights issue, there's no anti-dilution, then there won't be anti-dilution. Otherwise, it might kick in. If they've drafted it without considering that, then it's a very big risk the promoters are taking it. But I think, see, it also happened from the investor point of view. They should waive away the anti-dilution clause. Otherwise, the promoter will have 5% or less than that. How will you expect? They're not going to run the show, right?
In case of pharmacy, anyways, they're trying to take over the company, right? Why would they
take
do
over
that?
the company? Yeah, correct.
They're
So
anyways, that's the reason they're doing this round, right? The Ps are looking to take over the company.
So take over the company, and then you're going to pick in a new professional management.
Correct.
Then it is fine. But
that's what's happening.
Yeah.
But even when they're getting a new investor on board, they have done a rights issue, and then they're doing a transfer of rights issue, not doing a preferential allotment.
Yes, yes. So that is possible. So it would be in the agreement how it has to be done. The promoters can ask for it. Rights issue should not be there. See, for example, many times when I go for a merger acquisition, based on a future value, again I do it at a low value. Say basically many times what we do, if you look at it from a say swap of shares that is being done, I try to do it at a lower valuation than the actual valuation, because from a taxation perspective, I don't want to be hit by a taxation for paper to paper exchange. So I try to do it at a lower valuation. Now, if that brings a down round, if that is treated as a down round, it affects everybody. But actually, it is for the benefit of the company. So they would have got some exclusions for this down round. They have done some exclusions. Like things like COVID happened and then a down round had to happen. Of course, nobody thought about it at that point of time. But now, any agreements that are there, a down round because of a natural calamity, etc., they say you anti-dilution would not kick in time. So it's a change in the negotiation terms that is happening.
Correct.
So now just let us look into this as just to understand how this works. This is some interesting understandings. So founder stock is 6,000 6,000 rupees, and he gets 6 lakh shares. That just taken at 0.01, just to make it interesting. Series A shares as 3 lakh rupees at 10 rupees. Now issue is they're going for a down round, which is at 15 lakh at 4 rupees, which is getting them 3 lakhs at 5,000. So what is that anti-dilution that happens for it? This is how it is done. They take all the shares, that is total 9 lakh of shares. If it was allotted at 10 rupees, 9 lakh plus the new shares, if it was allotted at 10 rupees, what would have been the amount? And then take the old shares at 10 rupees and the new shares at 5 rupees, what it would be. And then divide the both proportionately, and they say the conversion for these shares of 3 lakhs would be at 1.21 times. So basically, this person will get, who had a 3 lakh shares, will also get additional 64,286 shares. Series A person will get it. So this is done on a broad-based basis. This is the way the workings are done. And for that, they get 27%. If you look at it, on a full ratchet, you got 2 lakh shares. Sorry, it is not the same thing. On a full ratchet, what would have happened? It would have got at, the entire thing at 4 rupees, it would have got for it. Basically, what would have happened at, so if he has to be allotted, this shares has to be allotted at 4 rupees. So now, let me say, sorry. So 4 rupees, if the average share for him should have been 4 rupees. So it is, he has got 3 lakhs. 30 lakh divided by sorry. So he should have been allotted, I don't know, I think I've done one. 7,50,000, 3 lakh shares, 4,50,000 shares should have been allotted. Instead of that, only 64,000 shares are being allotted to him. So that is on the broad-based one. And the other thing, on a narrow-based one, what they're saying is, they say that don't consider the founder shares, ESOP shares and all that. only take the investor shares into account and then do the weighted average. And when they do that, the ratio comes to 1.5 times what they get. So this investor would be getting 1,50,000 shares rather than 64,000 shares. So if you look at it, a broad-based one protects the founders, because if you look at it, on a narrow-based one, the founders holding has come to 42%. And on a broad-based one, it is 45%. So one needs to look at it as to what protects whom and what it is. Accordingly, you work upon a broad-based and a weighted average basis of dilution. And also sometimes what happens is uh, there's a cap on the dilution. They say that anti-dilution is allowed, but the dilution would not be more than 30%, more than 20%. So in that case, the for Series A, whatever his initial investment was, it goes down only to 20% down means 27%, and the rest is not diluted as such. So this is how the dilution cap comes into play. And then there's something called a pay to play anti-dilution clause. Basically, that says that if you don't participate in the investment, in further investment, then you lose your dilution rights. So that is what they pay to play. And some clauses are there which says there's a time bound. Anti-dilution is there only for up to 7 years. After that, anti-dilution is not there. The anti-dilution is there up to the market turnover reaches, say, X million dollars if we reach. After that, there's no anti-dilution clause, won't be there. These are the various terms that have come into the agreements as such. So, already now it's 12:30. I don't know how much time we already thought of 30, 1 hour max, and then for question answer, but already reached that. So,
Not an issue. You please take your time, and we will continue in the another session as well.
Okay, so you want
means actually you are giving information in the detail. That is really good. And जल्दी जल्दी करने की जरूरत नहीं है. हम again we can sit. Not an issue for that. Right?
So, I'm okay to continue, but if you guys want me to take a different session, we can have a second part of it and do that. However, what is it that common understanding of everybody is?
I think let's do next time, Vivek, if it is okay with you.
I'm okay. I'm okay. Because I still have quite a few slides and more of practical aspects that are there.
That is why this is very important.
Okay.
And really good, Vivek. It is really good. Means you have good knowledge and you are a good teacher as well.
Oh, thank you for that.
Vivek, can we have the spreadsheet that you were just showing, the anti-dilution, if it's not
Yes,
a issue with you?
yes. I'll put it in the group.
Okay.
And then do that.
On WhatsApp or?
On the WhatsApp.
Okay.
Vivek, my suggestion, can you take questions for next 10 minutes?
Yes, I can take questions. Next 5-10 minutes, I can take some questions.
Yeah.
Any questions are there?
Vivek, can we look at a valuation model for typically Indian investments? How do you generally, as a private equity investor, look at your, the IRR?
Okay, see, on a valuation model for an early stage investment, I think our professor explained it very well, and even the YouTube video that was explained. Basically, they look at the return. How many X return I need to get for it? Because, and then based on that, they reverse calculate what is the valuation. I'm investing $5 million today. I want 20X. So what it is, so it has to be, my exit value should be 100 million. So now exit value is 100 million. What is the, now what percentage I should get for it? And it's a 20X I need to get. So there's a 5 million, the investment. So basically, I think with the the process explained, but if you want, I can take it up in the next session. I can take you to an example for it.
See, my experience with this particular industry is that you normally fix the exit time as an investor. You normally fix an exit time, and then you also fix a rate of return, your IRR, correct?
Correct.
So what happens is, generally what happens is, let's assume 5 years and you expect an IRR of say 30%. Example, I'm just throwing a number.
Yes.
So what you do is you take the final year exit year's P multiple and your EPS,
Yes.
derive the market price, and do
Correct.
a discounting factor for the current entry price, correct?
Correct. See, basically what happened, most of the cases, what I've seen is, VC and the promoter agree upon a valuation number. This is called the calculation based on the venture capital. And then they come and say that this is what it is, and then I want a valuation report to be done. Then you do a DCF and various other things just to support that valuation. Otherwise, these valuations are actually a farce, because unless it's a matured company, DCF doesn't. DCF is the best valuation methodology. Such, but that doesn't work in a startup because there's no history for it, and everything is an anticipation and assumption of what's going to happen. Otherwise, in a matured company which is there for 15 years, then I know everything, and then I do a good projection, and then I can do a DCF and then come with a valuation. For a startup, DCF, though the law requires DCF in some places and all that, it's not there. In fact, the income tax law itself is doing away with DCF. Also, they're making it go away and then bringing in new multiples. They're bringing in.
No, but whether this is a startup or an existing company, don't you think the best model would be this?
Which one?
The best model which I was now in practice for almost VC and PE. See, the first thing they come to your table and say is, boss, 5 years exit, this is my price. This is the practical issues. So they say, boss, this is my price, this is my exit, this is my entry level PE, this is my exit level PE. Now, this is the market price estimate. This is the value I can give you today. This is what normally for all Indian investors or investors do it.
That's right. All investors do that as such. So, but where it depends upon when it's a startup, then the return, they come with a higher IRR.
Yeah, absolutely.
And there's no multiple based asset, no P multiple or anything. Multiple and all that they don't look at it.
Correct. Obviously.
Mature company, they look at a forward year multiple. 5 years down the line, this is the EBITDA multiple I can get. That's the valuation. So that they look at it. But in a young startup, even that is not looked at it.
In fact, I have one more observation that most of the PE investors these days, in fact, post-COVID, are looking at companies where they have an existing listed company where they can do a reverse merger for exit strategies.
Yes, that's what is there. Definitely.
Yeah. Nice, Vivek. That's nice session for me.
Okay, so let us go. I will share these things on the WhatsApp, and then we can. I'll also share the slide also, whatever it is, and then whenever you guys want the next session, I will be happy to take it up. Saturdays are okay for me in the first hours.
Vivek, just a request from our side. We are from Group 5, so if you can allow us to continue after all of you leave, we can discuss those 3 leading questions on the session, and we can continue in the same meeting.
Please,
Vivek, next time means I want to maybe some other persons will be there, but I want to more understand about the valuation methods. Which we report in the financials. Obviously, means somebody in the teams they do valuations, but I just have a upper knowledge on that valuation spreadsheets.
Sure.
And if you can teach us on how to read these valuations, and anybody in the team can help me in the actuarial certificate reviewing, because now in I have to review some certificates of the actuary, but I don't know what to review in that. So it means anybody from the team, if
somebody
they have good
take up actually evaluations. That somebody, I have not done actually evaluations. I've never done that.
Anybody in the team who is good in the valuation, who is daily dealing in the valuation, then they can help us.
We, as a firm, we do valuations for business valuations, not actually valuations. That's a little different. Actually valuations.
No, not on actuarial. Actually, I have 2 questions. One is the business valuation, and property investment property valuation. And the third one is actuarial certification disclosures.
Okay. Actual certificate disclosures, if you want to, then I have a partner.
Usually what we do, we took the financial of the previous year, we just update the numbers from the actuarial certificate. But now I'm in the position that the promoter asked me to at least check whatever the certificate which we have received from the Charan Gupta. And yesterday he told me that
you can connect with me. I can help you with that. No problem.
Thank you, Tanvi. Thank you. And in another session, means one-to-one, I can connect to you. In that.
Yeah, you can connect with one-to-one. No problem.
Thank you, Tanvi. Thank you for your help.
Thank you. Okay.
Thank you, Vivek. It is good class.
Thank you.
Really helpful to understand that.
Thank you so much.
Nice insights, Vivek. Thanks for that.
Thank you.
Looking forward to the next one.
Stay back.
Thank you.
Thank you, Vivek.
Thank you,
Group
Vivek.
6 can't join this.
Thanks, Vivek. Thank you.
Group 6 can also join this, right? Same questions we have to answer.
Yeah. But I think we have one more. Group 5 and 6 have different case studies. I'm not sure what is required.
Ankit, we are
Yeah.
staying back, right?
Yeah. I'm
You are
saying
in
for
group 5. Ramkrishna is
five.
also in our group, right?
I'm there.
Yeah.
Group 5 and group 6 also, I think, same.
Yeah. So even group 6, if they want to, they can stay back.